Hey, this is Danielle. In today's trade review video, I'm going to be going over an SPX iron fly that I did. It was a trade that I did right at the close today. It lasted about an hour. It was a day trade, and it was also one of my $500 or less risk trades. So I'm going to go ahead and go over this. I did this live in the Simpler Trading options room today, and this is my review video. So, just looking at the trade, this is kind of how it played out. Basically, I was risking $390 a contract on this trade. In the options room, I tried to post trades that are $500 or less. So, right here, you can see that the max loss was $390 when I got in, and the max profit was $610. So, I normally try to have, at least a 1-to-1 risk reward. Definitely achieve that in this instance. If I can have, you know, better risk to reward, that's always amazing. With regular butterflies that I do, I try to get at least risking 1 to make 3, upwards of risking 1 to make 5. Sometimes more, I'll do 1 to make 10. But in this case, this was a premium selling trade. So when you're trying to sell premium, try to get like a 1-to-1 risk reward. So in this case, it says selling an iron condor. That's what they call it in Thinkorswim, but it's really an iron fly. So, anyways, when I got into this trade, basically I sold the iron fly for a premium for credit of $6.20. This was a $10 wide iron fly. So basically, I was selling the 5600 call. I was also selling the 5600 put, and then I bought 2 outer wings for protection. You do this so that you have defined risk in the options market, and no matter what the market does, there's no way you can lose more than $390 contract, which is why I like that. So, why did I do this trade? Well, I did this trade because the market was pretty stagnant today. Typically, when you have a news-related catalyst coming up, like in this case, Jackson Hole, and then you also have a market that's just been incredibly strong and it's just kind of just lost a little bit of momentum. Typically, you can look for some of these neutral trades. So this is my 5-minute chart of the S&P futures that I use when I'm day trading at the end of the day. In this case, you can see that it wasn't really any kind of trend. The trend strength turbo candles are red, and then they're green, and then they're yellow, then they're red, and they're green, and they're yellow. That just means that it's chop. So when you have a choppy, boring day, you might think, oh, there's nothing really to do here, but you can sell an iron fly. The other thing that I will look at too is going to be the ticks. The ticks are really important because the ticks show the buying versus the selling pressure. In this instance, we had the ticks pretty much between -600 and +600 for the vast majority of the session. And especially when you get down to those last 30 minutes, you want to see the ticks in this neutral range. If you're doing a neutral iron fly, like I was doing, and they were in fact staying between -400 and +400. So that was why this was a good day to use this strategy. I also use the vol spread, the put call ratio, look at the UVXY as well. This was all pretty neutral. The vol spread did start rolling over at the end of the day, so I was considering that maybe the SPX could roll over, but it didn't actually end up rolling over, so that was good. Put call ratio was pretty flat. The VIX did start spiking a little bit at the end of the day, but we really didn't get anything as far as a rollover in the indexes. So, why did I set up this trade like this? Well, I can go back and show you some of the screenshots that I took when I set up the trade. I also have the recording from the options room. I was going to pull out a piece of that just to demonstrate how this worked. But essentially, when I put the trade on, the SPX was trading right around 5,600. So typically with these neutral flies, you want to sell the premium when the ticker is trading as close as you can to the strike that you're selling, because that's how you make a neutral trade. In this case, it was trading at 5601.58, and I wanted to sell the 5600s. Now, why the 5600s? Well, this strike has a whole lot of volume with the interest surrounding 0 DTE SPX options. There's a lot of volume there, and so typically what will happen is the market will trade to those areas that are a little bit sticky. Generally, they're going to be the key psychological values that have a lot of volume and open interest. Typically that means that the sticky point strikes are going to have 2 to 3 times the volume and open interest of the surrounding contracts. So that's something that I'm looking for. As far as the range, people ask, well, why did you do it $10 wide? Well, it's because of what the expected move is into the end of the day. So at the time when I got into the trade, the expected move into the end of the day was $9.12. So there's really not a reason to do it wider than that. Just generally want to make it at the expected move because, sure, could a bomb hit and the SPX moves, 30 points? Yes, but there's no reason to have a 30-point wide iron fly when the expected move is $9.12, because the only thing you're going to do is mess up your risk to reward ratio, because the wider you make it, the more risk you have, and it's not going to give you that much more premium to do that. So when I first put on the trade, I got $6.10. It was negative initially, but as time went on, I basically managed it by watching the 5 and 15-minute charts in the SPX and definitely the S&P futures, because those are going to lead. In this case, we did have a 15-minute squeeze that I was monitoring pretty closely, and we do have a bullish pattern here too. So there is always that possibility when you're doing a neutral trade that, the buying is going to pick up and then it's going to explode to the upside. In this case, that didn't happen, which is great, which is why the neutral trade worked. But that's why you have to monitor the ticks. If you start seeing the ticks hit up above plus 600 and plus 1,000, like, your neutral trade is not going to work because the consolidation is breaking out. So just want to make sure you're watching that. These are just a couple other screenshots that I took just as the market was moving. As it got closer and closer to the close, the volume continued to pick up in the 5600 series. You could see that there was just a lot of trade back and forth at these strikes. And, what was really interesting about today was that the premium held on until the very last minute. Now, with these iron flies, I have been finding that if you take them off before the last 10 minutes, you are going to be right more often, because a lot of the times those last 10 minutes you're going to get a big move. But today I don't know, I left it on because I was monitoring the market internals and I didn't really see anything moving. So I did go ahead and let it cash settle. This screenshot was at 12:55 Pacific time. So even when there was 4 to 5 minutes left in the trading day, there was still quite a bit of extrinsic premium in these 5600 options. So when you change your options chain so that you can see the intrinsic and the extrinsic value, that tells you how much more premium decay is left in those options when you're trading something that is about to expire. What that means is that extrinsic value is going to, continue going down to zero, so long as the ticker stays at the same spot, of course, when this thing expires. So I knew if I just, waited a couple more minutes and the ticker didn't move too much, then I could make more money, because with 4 minutes to go, I was up 25%. I was making $157 with my risk of $390. So, I mean, it's all right, but of course I wanted to make more. So I did hold it a little bit longer. I walked through my management in the trading room. At the end of it, the market closed and the SPX closed at 55.9710. So not a perfect pin. The perfect pin would be if it closed right at 5600, but it's still plenty to, make more money. So in the end, that ended up, it's not exactly perfect at 317, but it was about 48%. Let's call it 50%, making about $300 on that $390 risk. So that is not bad for a less than $500 trade in a span of about an hour. I think this is a really good example today because everything was just so choppy and boring. I was looking around. There really wasn't anything to do from a swing trading perspective that I could see. The market's been extremely strong. It's rallied really well off the lows, but you really don't want to be getting into swing trades after the market's rallied for 8 days straight. I mean, it's just going to be the worst spot to try to buy any long. So when you're looking around, you're thinking, what can I do? Market's trading sideways. Nothing's really happening here. You check out these SPX options and see if there's a pinning play. And this is what I'd call a pinning play. You have the neutral ticks, you have the back and forth chop, market internals. Yeah, they did move a little bit, but nothing too crazy. And you're really just making a play on that high open interest and that high volume in the options market, and you are trading premium decay. So this is my review video. I was also going to post a snippet from the trading room just to show, how I managed it live. I don't know, just thought that would be fun. But this is my trade review video. If you have any questions, let me know below, and I will get back to you as soon as I can. Hope you have a great rest of your day, and I'll see you in the next one.